we're here today to talk about the Wharton study. And Eric, before we get into the Wharton study here, and I know this kind of ties into it, but let's just talk about fixed indexed annuities, which is what the Wharton study is about. Let's talk about the popularity of fixed indexed annuities in recent years.
Well, it comes into why did we decide on this topic today. Just recently, LIMRA came out and gave us some of the tallies from 2011 about what the most popular annuities and the flavors of annuities that were out there were. And of the fixed annuity chassis, or so to speak, of that flavor, indexed annuities amounted for 41% or 44% of the sales in the fixed annuity chassis world, and which was over $30 billion, almost 32, about $32 billion in sales of fixed index annuities.
And that's been going on for the last couple of years.
Yes, they've been increasingly popular since they kind of came into existence in 1995. They've kind of gradually built, and now they're pretty consistent at being over $30 million in sales.
Yeah, which is very good. And one thing I'd like to do is maybe tie that back into the Wharton study, which we were talking about. We've got up on the board and it's sitting here in front of us. And the Wharton study, folks, if you haven't read it yet, it's available at our Annuity Reviews blog, and so you can get the link there. But you might find it to be good reading because it actually takes what was just assumptions that were maybe based on erroneous types of assumptions, and actually brings it down to real data. So that we can actually look at fixed annuities and compare it even to the popular indexes, like the S&P 500, and just see how it really performed.
Well, and I like some of the fascinating statistics they toss in there. And they look at an index annuities being part of an index, and one of the things they analyze and they break down is the Russell 3000, and I just find that index comparison fascinating because they say, the Russell 3000 takes into account 98% of the stocks that are out there. And they said when they looked at it in their analysis between 1983 and 2006, that has 98% of the stocks publicly held in that index.
Yes.
Of that, and this is the fascinating statistics for me, 40% of those stocks had a negative return during that time period. 20% lost all their value, while about 10% gained over 500%. So, what their determination was when they said you're better off picking the index because you're going to cover all those bases in there. You're going to get those big returns, and if you're picking individual stocks,
well, you could be on either side. And the chances are much more likely to be on the downside.
You can hit the home run, or you can hit the strikeout, and you're back in the bench.
And let's talk about the last decade or so, 10, 12 years, what we call the lost decade. And how did fixed indexed annuities, I'm asking a rhetorical question here, but how did fixed indexed annuities compare to, let's say, the S&P 500 during that first decade of the 21st century?
If you take the decade as a whole, everybody kind of looks at that 2000 to 2010. And the S&P was basically flat.
We call it the lost decade.
There's nothing there. But if you were in the indexed world, you got good returns.
And when we're saying the index world, we're talking about the fixed indexed annuity world.
Well, in this case, we're talking about from an indexing standpoint, because of how indexing works, you get the gains and then you lock them in. Get the gains, lock them in. Now, when the losses come, you're locked in. So you don't take that back. That's where we call it zero is your hero. We've kind of talked about that a couple times. And that's where this comes in, and it points out, the Wharton study points out that because you're not having those big drops, your returns over a period of time were actually pretty good. Now, are we predicting future performance with this kind of study?
It's going to outperform the market in a good market? I would say no. But on the other hand, I've had a lot of folks that have actually sat down and we've talked about that difficult time, like with the S&P and the major indexes, and when we look at the fixed indexed annuity and we look at several of the different annuities that have performed during that time, and it's borne out in the Wharton study, is that they actually outperformed those indexes. And the reason they could do it is just what you were explaining, and that is because when the index drops dramatically, with a fixed indexed annuity, it actually locks in all the gains, that it's had It might just have a zero, no increase in that particular year, but now it's locked in at a new low. Right. So what happens the next year? The market goes up. Maybe the market doesn't go up enough to make up all that it lost, but any gain that it has, a portion of that goes to the fixed indexed annuity.
Right. So your interest in crediting coming off a bad year is a good thing.
Is a good thing, right, yeah. Right. So that in essence, that allows it in extreme volatility or flat or down, right, to actually produce a real return where the market can't produce a return, but the fixed annuity, right, fixed index annuity can. Let's talk a little bit about the way that a fixed index annuity actually is able to accomplish this. I mean, a little bit of the inner workings, the mechanics of it.
Well, I'm not a brain surgeon, but I can tell you they utilize options, put options, yeah, call options.
Well, call options is
primarily
what they're using.
Right. to basically buy pennies on the dollar. You're buying the index.
Correct.
The strategies of the indexing. So you're buying pennies on the dollar, and if you get the gains, you get big returns.
Right.
And if
right.
you get losses, they expire basically
right.
worthless.
Exactly. They allow the options to expire for pennies on the dollar, and these large companies are in a position to have the type of financial management to continue to manage money in this way. And let me also take this, you know, in the other sense of the safety of the annuity. The actual premium that's put into the annuity is fully guaranteed in the sense that it's invested in treasuries, investment grade bonds, very high quality investment instruments, so that it can guarantee that the principal will be safe and that there will be a minimum return that's guaranteed by the fixed indexed annuity company, even if the market doesn't perform, right, or the call options don't perform.
They're using the power of leverage. I mean, right, it really is that. That's how they're making those dollars and bringing those returns, those interest crediting, right, back to.
Well, and now we do know that the fixed indexed annuity performed very well during what we call the lost decade, and it actually outperformed many of the indexes that it was being used to measure against. And I can see why that drove a lot of business into the fixed indexed annuity market. Now, as of late, the last couple of years, what we've experienced has been lower caps.
Right.
And yet, fixed indexed annuities have continued to sell like crazy. People have continued to pour money into these to the tune of $30 billion. Well, last year, $32 billion.
And I will tell you, it's just another safe money alternative when you compare it to money market accounts, right, CD accounts.
Right.
But your opportunity for growth, we never thought 3% sounded like a slam dunk. But well, 3% is a great return when your CDs are paying 0.5%, your money markets are
right,
paying 0.25%.
Right. Right.
3%, all you need is one good year
right,
to get you a 3% return.
Right.
And it kicks the butt out of anything
right,
that you've had from the bank.
Well, and then we come into this whole hybrid annuity concept where it uses the fixed index annuity chassis, and then it has this innovative income rider on it that guarantees 8% compounding, because what we find, Eric, in our practice is that many of our clients actually need income.
Right, and we should say the 8% is not on every annuity rider, but 7%,
8%.
The riders
some
are
of the little small,
right,
6% on
the
some
rider,
of them.
The riders out there in deferral are what you can use to guarantee income,
right,
and that is a huge predictability for retirement income.
Right.
And so when
right,
people are looking at a fixed index annuity and then taking that additional rider option, it becomes a very powerful thing, and even compounds what they found in the Wharton study.
Right, right, and I do believe from everything that I read and see and hear that as we have more and more baby boomers that are coming into retirement, and they have to have answers for secure income, what we would call a pension-style foundation to their portfolio, that annuities are going to continue to be a viable answer in that area.
Yeah, we're seeing more and more endorsements. They're seeing endorsed by the government, endorsed by people like ourselves who are retirement planners.
Yes, that's right.
And basically becoming a large portion of what you should utilize perhaps as part of your retirement.
As a portion of your portfolio. Yeah.
For securing retirement.
Well, I think we've covered the Wharton study in the sense of the general idea of what it's about, and really want to encourage you to go ahead and check it out.
Yeah, check it out online. more than happy to put a link out there for you on our site. So take
Yep.
a look, and
Thank you.
thanks for coming in.